Few things are as misunderstood as bridging finance. It sounds scary and intimidating and puts a lot of property investors off of buying through auctions or cash purchases with a normal estate agent. It's something where people fear high interest rates and that it's going to cost too much money, or what if I can't make those repayments on the property? But actually, it's a wonderful product that, if used right, can be really, really powerful as a tool. It's a powerful asset that can help you generate a lot of money through flips and BRRR deals, otherwise known as buy, refurbish, refinance. And those higher monthly interest rates shouldn't be a problem if you're analysing the deals correctly and also making sure that you're making a profit at the end of the project, because you just factor that into the costs. And ultimately, it's going to allow you to purchase these deals that you otherwise wouldn't have had access to, so therefore it's worth the cost when you factor it into an overall project. So let's explore the basics of bridging finance. Now, firstly, the value that you can get in terms of the mortgage is more so based on the property than it is your income. So if you're buying a residential property, it is means tested on your income and then stress tested off the back of that. But with a bridging loan, it's more about the value of the property itself and less about you. It doesn't mean that they don't consider your income whatsoever, because they do, but it's more about that property, and that's what they'll be considering. Secondly, they will place a charge on the property like any other secured lending. This means that if, for example, you default on the repayments and you stop paying back the interest, or you can't afford it, or something goes wrong, whatever it is, that they can sell the house or the flat or whatever it is you're purchasing, and they are the first people to be repaid the money. Therefore, they make sure that they can recoup the funds that they've given you as the bridging loan. And of course, you can choose whether you pay the interest at the start, as a monthly period, or at the very end of the product, which is really, really interesting. And unlike a normal mortgage where you might have it for 20, 30, 40 years, with a bridging loan, it's only designed to be used between 6 and 12 months. You can have a little bit less, you can have a little bit more. But that's why the interest rates are very different, because it's meant to be used for that short amount of time while you're refurbishing or working on a property to then refinance it onto a longer term product. When you compare the different interests, on a normal residential mortgage, you're looking at around 1 to 2% at the moment in the current market, and that's currently going up. Buy to let, I would say, is about 2 to 3%, depending on your company structure. Whereas when you look at a bridging loan, that's about 8 to 15%, which sounds really scary. But again, if you're factoring that cost into the overall project, then it's just an additional cost. And when you're making tens of thousands of pounds of profit on a flip project, then really that's not something that you should be really worried about. So there's a few interesting points to mention about bridging lenders that's a little bit different to the standard buy-to-let mortgage or a residential mortgage. So firstly, as we've mentioned, bridging loans tend to be based more on the actual project or the property itself at its value or its done up value, depending what kind of bridge that you're going for, compared to a residential mortgage where it really is about you and your income that you're bringing in terms of the household, which then affects how much you can actually borrow. So it means that people on slightly lower incomes can get a bridging loan. It doesn't mean that if you're unemployed you can get a bridge, because that's going to be very, very difficult, but it means that that affordability is assessed very differently. Secondly, unlike a buy-to-let where the mortgage is stress tested against the rent in the area, bridging loans aren't designed to be used while renting out a property. Therefore, the lenders aren't bothered about how much rent you're going to get for it and whether someone's going to be in the property within 30 days. And of course, it's pretty common for the house to be empty while a bridging loan is used, and the lender knows and understands this. Thirdly, the condition of the property really doesn't matter. With a standard normal mortgage, buy-to-let residential, you have to have a house that's mortgageable. So it has to be structurally sound. It has to have taps and basins and drainage, and that is a really, really big factor, because if you don't have a sink and running taps in a property, it's therefore not mortgageable. Likewise, if there's no kitchen in the property, again, it's not classed as mortgageable, whereas for a bridging loan, that's not a problem, and the lender won't be concerned about that. And lastly, bridging finance can be used really, really quickly. Some people can complete in as quick as a week, or usually the average, I'd say, is about 3 to 4 weeks, which means it's great for auction purchases, and if you're in a rush and you need a speedy sale, that's the perfect product. So why use bridging finance? It's for a shorter term and it's more expensive. So why and when would you use it? Well, a lot of bridging loans are used either for auction purchases where you need to complete within 28 days, usually if you buy an auction. If you do not complete after that specific time period, then you can be subject to really, really heavy fines. But mainly, if you don't want to hold a property for a very long time, then you therefore either have to buy in cash because you don't want to be getting a mortgage, it's costly, it's expensive, and there are a lot of clauses against using mortgages for the short term. So it's great if you're wanting to flip a property or it's not mortgageable, there's something wrong with it, you need to bring it up to a good standard first, and then you can refinance it onto a normal mortgage. That's also known as buy, refurb, refinance, and there is sometimes a rent on the end of that as well, so that's BRR or BRRR, and that is a really, really common property investing strategy that a lot of investors use. It's where you buy an unloved old property, you do it up, you add some value, you can get some of that cash from the bridging loan as well, so you don't need to fund the whole thing yourself, because some bridging lenders can base the actual loan they give you off the gross development value rather than what you're purchasing it for. So there's a little bit of leverage to refurb the property and then refinance at the higher value onto a brand new mortgage where you then repay off the bridging loan, get a little bit of profit left, and then the rest is the deposit on the new value of the property. Sometimes you might see with estate agents that certain listings mention cash buyers only. Now, don't be afraid or put off by this. You can still make an offer on a property that says cash buyers only. Usually that's because they either want a quick sale or there's something wrong with the property, and you can come in there with a bridge and that's still perfectly okay. So cash buyers still means bridging finance is okay for that type of purchase, and a lot of investors don't realize this and skip past all of the cash listings if they don't have the money. The main thing is just be honest with the estate agent. Tell them that you're using a bridge, but it's pretty much the same as cash. Most estate agents understand that. If they don't, just quickly explain it and say that you can still complete within a few weeks maximum. It's exactly the same as cash. How much can you borrow on a bridging loan? Well, the amount really can vary, and in this particular product, it's really about the project itself. There are different types of bridges that you can get. Some will be based on whatever you pay for the property. Now, this is really, really important because when you get a residential mortgage, typically they will send a valuer out to the property and they will value it at whatever they think it's worth. However, let's say that you're buying a property for £200,000, but actually you get it for 180. Now, when you get a mortgage, that means that that valuer will take it at the face value of what you've offered. Therefore, you can only get a mortgage on £180,000, even if you know every other house on the street sold for 200. But with a bridging loan, they will look at the actual true value of the house. So if it's worth 200 and you bought it for 180, they can still give you a bridging loan of £200,000 because that's what the property is worth, even though you got it for less, which means you've got 20k leverage in the middle to add a refurb and add some value onto the property. Another type of bridging loan is where you can actually get the gross development value, or at least 75% of the gross development value of the property. So if you know that property is worth 250k, they could give you 75% of that towards purchasing the property, doing the refurb, and then you can refinance off onto a longer product. On the other hand, valuations can be very, very subjective, and it means that you might be in for some disappointment. If you've overbaked the figures and you've analysed the property a little bit incorrectly, it means that when the lender sends their valuer out, they might actually value it at less than what you're anticipating, and the lender will take that valuation at face value, meaning there's no negotiation on the price. We all do it. We look at projects really optimistically and inflate all the numbers and try and make it really, really work and squeeze the last few bits of pounds out for the profit. But you have to be very conservative and reserved when it comes to analysing deals and using bridging finance. That way, if you've got a property that you know you're being reserved on the figures, but it's still making a profit after you've considered fluctuations in the price, in the sale price, in the GDV, and in the refurb cost, then you really cannot go wrong because you've analysed it in every stress test scenario. Also, lenders will want to know a lot more about you as an individual as well. In a bridging finance agreement, they'll want to know more about your experience. Have you refurbished a property before? Have you got a solid build team behind you if you've not got that refurbishment experience? If you're converting a property into an HMO, have you got any HMO experience? Have you done that large-scale conversion before? If you're going from commercial to residential, have you done that before? And all these really, really matter and will change the end interest rate that you're going to get. They'll also want to know about your exit strategies. And notice that I said strategies there because they'll want to know what's option A, but if option A doesn't work, what's option B? If you're converting a house into a HMO, but then all of a sudden you have licensing problems and you can't get the license, or you've bought in an Article 4 area and didn't realise, or something goes wrong, they want to make sure that you can still repay that mortgage and get a refinance by having multiple exit strategies, and that's really, really important in the planning phase of the process. They'll also consider, is the scale and size of the project completable in the length of the term that they're going to give you. So if they give you a 4 to 6 month bridging loan and you're doing a complete renovation, commercial to residential, they're not really going to give you that product because they know it's not going to be done in 4 to 6 months. They'll also be looking at, is the final product going to be marketable or not? Is there a demand in the area for the product? And they want to make sure that you're going to be getting off of that bridge as much as possible. If you opt to pay the monthly interest rates, then they'll also be looking at your income to some degree here because they'll want to know, can you afford those monthly repayments while you're working on the project, because the property itself isn't going to be bringing in money, therefore they know and understand that those monthly interest repayments are going to be coming from you personally. Next is the fees. Now there are a few different fees to consider. This is what really puts property investors off of using bridging finance, but as I've said multiple times, If you factor these costs into the project, just like you would for the refurb costs and the legals and the stamp duty, if you're stacking up a deal and it works with the typical costs behind bridging finance, then you should not be afraid to use it because you've factored that cost into the whole project. So some of the fees that you need to consider is firstly the initial valuation. Now this is usually between £300 to £500 depending on who the lender uses. Secondly is the arrangement fee of the loan, which is typically around 2% of the total value that you're borrowing. You usually have to pay the lender's legal fees as well as your own on top of that. And then when you're looking at the end of the bridge, you usually pay a 1% exit fee on top of everything altogether. If you want to repay the bridge early, most lenders are okay with this, but sometimes there might be an early repayment fee, so definitely check the T's and C's because a lot of brokers will recommend go for 9 months, expecting you to repay within 6. Just make sure that that 6-month mark doesn't mean that you're going to be hit with any extra additional fees. Likewise, if you're overrunning the project and you need to extend the bridge, there are going to be more fees associated with that as well. And then lastly is the broker fee, which is around 1% of the total loan value. So it does sound pricey, there are lots of extra costs, and yes, it is a higher cost product, but if it's going to make you a profitable deal that you wouldn't otherwise have had access to, then why wouldn't you go for it and use it? It's a great product when you use it properly. Another thing to mention is that what you will be paid is actually the net amount of the loan. So let's say you're taking out an £80,000 bridging loan. Rather than getting the full £80,000, instead they'll take all of the fees off of the loan straight away. And then you'll be left with, for example, you're paying the legal fees and then you're going to be paying some arrangement fees up front. If that 80k then includes 2.5k costs, you'll get a net advance, which is £77,500, and that is the amount of cash that you'll have to play with as the actual bridging loan. Now, in terms of the interest, there are 3 main ways to do this, which makes it a really flexible product. So firstly, the interest can be taken out at the start, meaning if you're going to be paying 9 months on a bridging loan, you can just put that on at the beginning, take it out of your cost, and therefore your net advance is going to be a little bit lower. So that might be 75 or 74,000 rather than the full 80, which isn't a problem because if you finish the project early and you want to get off the bridge after 6 months rather than 9, and you've paid 9 months interest, you'll get that money back from month 6 to month 9 that you haven't used the bridge for. Some lenders might charge for it, but just check the T's and C's. Most are usually okay with this. Secondly, you can roll it all up and pay it at the very end. Again, if you use 6 months rather than 9, you'll just pay what you use at the end of the project, so you don't have to worry about the interest while you're working on the project, which means in theory it doesn't sound as risky because by that point you've finished it, it's all good, and you're already refinancing it onto the longer term mortgage. Or lastly, you can look at servicing the bridging loan, which basically means you're paying the interest on a monthly basis like you would do for a normal mortgage. So let's say you've just purchased a property at auction today. How do you actually get bridging finance? Well, Lendlord, who have kindly sponsored this video today, have their own online finance lender. It's a really useful online bridging tool where you can get a decision within 3 minutes. There's no broker fees and no early redemption charges after 3 months. They'll offer up to 75% loan to value, and the whole thing is completely online, which in 2022 can be a really, really good help rather than having to send forms back and forth with a different lender or bank. If you're a little bit unsure or just want to learn a little bit more about bridging finance from a specialist, then you can easily give them a call and chat to the team, and they will happily help you and guide you through the bridging process and talk you through the product in more detail. When I was working on my recent property project where I renovated a buy-to-let property built in the 1950s and made a £15,000 profit, I was debating whether to use bridging finance or just get a mortgage and fund the actual refurb myself, and I used Lendlord's online bridging tool to get the rates and get a really good understanding, and it was really, really helpful. You can check them out by going to lendlord.io or just check out the link in the description and that'll send you straight through to their bridging calculator. Typically, with a little bit of back and forth, it's really easy to get a bridging offer from 1 week up to 3 to 4 weeks at the very, very maximum, depending on how fast you are and how fast the solicitors are. There are a few things that might slow you down, so be aware of these and try and mitigate the risks. Firstly is the time it's going to take to get a valuer booked into the property. Now, if it's taking a while to book an appointment or there's access issues to the property, then that will slow you down. Secondly is how quickly your solicitors work, so make sure you get a good, trusted, reputable solicitor who can deal with auction-style purchases that are really quick. Thirdly is making sure that you provide and supply all the information that they need as a part of the application. The longer it takes you to gather documents and prove all of your circumstances and all of the project, the longer it's going to take to get that money. And lastly is, after all of this, is how much digging the lender wants to do into you. Some lenders might go in to really really extreme detail, which means it's going to take a long time. Others might trust you and they're happy with what they're seeing in front of them and don't need to dig too deep into you or the project because they're happy with what they're seeing. Overall, here's a few things to consider if you're thinking or looking at bridging finance. Firstly is, can you benefit from the higher costs and fees of that financial product? Now, it is more expensive than a normal mortgage, but it's designed to be used in a very specific way. And if you're flipping a property, having it for a short amount of time, or you're refurbishing or refinancing the property, then it's great because you can buy it, you can do all of the refurbishment on the inside and then refinance at a higher value and pull out all of that cash or as much as possible. When I worked on my buy-to-let deal, the margins were actually quite slim at the time, which is why I decided to go for a normal mortgage and fund the refurb myself and instead refinance it in 2 years. But actually now looking at the figures and how strong it was, I wish I would have bridged that property because I would have been able to pull out £40,000 that is now trapped in there for the next 2 years. And the second most important point is, do you have a solid exit strategy? It's really important on a bridge to get off of it. That's the whole intention of the product, is to enable you to do something in a property project and then get off into the longer term financial products. Now, you need to make sure that you're thinking about multiple exit strategies. If you're going to be building a HMO, you need to make sure that if something for whatever reason gets in the way of that really complex project, or you have issues in planning, that instead, can you convert that project into a normal buy-to-let property? Could you sell it as a flip, as a normal family home? And that is what's going to really protect you against any additional fees or issues with the bridging product. Hopefully this video has put your mind a little bit more at ease and opened you up to the world of bridging finance. I'm definitely looking at using bridging on my next project, and I think it's a great product that really enables a lot of flexibility and helps property investors grow as well in their businesses. So I really hope you found this video useful. If you enjoyed this, then actually check out my buy-to-let refurb here. This is the entire playlist where we go from creating the initial 3D renders, doing all the deal analysis, to then actually going into the property, and you can see the before and after shots. It's really interesting, so definitely check this out.